Nice. Okay, well, welcome to Upstream with River. I'm your host, Kieran Berry. Today, I'm joined by two of our advisors, Daniel Phan and Kenneth Monares. Thank you for coming on.
Thanks for having us.
Before we get into it, just a quick disclaimer for everyone. Anything you hear on the podcast shouldn't be considered as personal or general advice. This is all for information and educational purposes only. But thought I'd have a bit of a change of gear on the podcast. Normally, you have your investment managers grilling a team of fund managers, but we thought we'd bring two of our wealth advisors on. So guys, welcome. Thanks for joining me here today.
Thanks for having us.
Thanks for having us. Yeah, it's a pleasure.
Great to be here.
Yeah. But for the benefit of our listeners, I might start off with you, Dan. Maybe tell us a little bit about sort of who you are and where you come from.
Yeah, so I've been working at River for a bit over 6 months now. Prior to that, I was working as a stockbroker, financial advisor, and the head of crypto at my previous firm. I've always been interested in investments. My family has run a business since I was a child, so I've always sort of been exposed to, not finance necessarily, but that entrepreneurship mindset and that hustle that you have as coming from an immigrant family. But I've always been interested in finance. I remember when I was a kid, my dad would have like Money Magazine books and that sort of thing. And I was always drawn to them. I was always drawn to the idea of wanting more for myself and my family. So I guess that pursued me to study finance and like commerce during high school. I took a really good liking to economics. I remember during HSC, I would study economics when I was stressed out. And I ended up getting a really good grade for that, which led me to study finance at University of New South Wales. And yeah, I've started working at Commonwealth Bank at ComSec through the trading division during my second year of uni. And I wasn't always the most book smart person. I used to get okay grades, but I know when I started working, being a younger guy and outperforming most of the people that had degrees already, that's what really motivated me to pursue, investing and finance in general. Really. Yeah,
that's awesome. Great. And Ken, tell us about you.
Yeah, so KB, I've been in the industry for a little over 2 years now. But my path to where I'm at now as a wealth advisor wasn't always as linear as Dan's, for example. So I think at the core of the way that I've navigated myself in my professional life has been really around relationships and nurturing those relationships and fostering those meaningful relationships and building on them, right? Because I guess the ethos of where I've come from is really built around trust, which I think is key and necessary within our industry, right? But my business acumen really stems from being in business first and foremost. I lived in the Philippines for the better part of 4 years, and there I initially went there to be a music artist, funnily enough, and then was handed the keys to the Philippines' #1 independent record label, where I was amongst some of the top celebs in the Philippines in music and TV. And what I mean by being handed the keys is I was given the reins to run the company as a CEO. And scaling the company from 2 to 3 different artists to a point where we had about 7 different artists along the way, and then COVID hit. COVID hit. Everyone had to figure their way around town and find a pivot. And mine was being tapped on the shoulder by one of my really good mates to be able to start a manufacturing company in garments. That's what I did. Moved to Sydney. Missed my family a little bit too much. Reconnected with Dan. So Dan and I have been friends for the last 13 years, who was like, hey, mate, I think you'd be a great fit for what we do at our old firm. And then you found us. About 5-6 months ago.
That's right.
Yeah.
So that's where you get those nice suits from.
Yeah.
He's always got sharp suits.
Yeah, so that's me.
Yeah. So it's interesting, right? Because So River has been around for just over 12 months. We've gone from Julius and I, who founded the business, to 15 independent advisors on top of Julius and I. And we've got 3 more that have joined us just recently. So pretty soon we'll have over 20 on the AFSL. And then on top of that, we've got a bigger support team. So I'd say we've got about 30 staff overall inside of 12 months. It's been a pretty wild ride. But one of the reasons I wanted to bring you guys on here today is you two are actually the first two advisors that I brought on outside of Julius and I, if you recall. When you came over, we had me, Julius, and Gil.
Yeah.
The office was still getting its furniture installed.
Yeah.
I think when you guys came, I didn't even have the TVs up.
No.
I think we were still buying computers when you came in. Like we're still putting screens on the desks. Like it was a pretty early time.
Yeah, it was.
And the reason why we went with you guys was because of that background, that sort of business mentality, your focus on growth. We thought it was a really good fit for our business going through that period of growth. But you both came from a stockbroking business that was focused on direct equities and your traditional buying and selling of BHP, CBA, and things like that. Tell our listeners a little bit about how has the transition been from moving from traditional stockbroking business to a wealth management, a more comprehensive wealth management offering. How's it been for you, and how's it been for your clients?
Yeah, I'll start. Challenging yet rewarding, I'd say, to summarize it. Challenging in the sense where it's you learn about these things in university, all these different sectors, all these different ways to value and analyze different investments. Whereas before it was more, you're in the stock market. It's, what's happening day to day. Also looking with a long-term lens, but it's just a very different game compared to what we came from, essentially. But rewarding in the sense where I think clients like it a lot more. It's much more of a longer term outlook, a more safer way to invest with what we do, focusing on alternatives, I believe. And ultimately, I think it's where I saw myself wanting to be longer term in my career, just having access to different options for clients, being able to have more control over the investment strategy and over outcomes is very important to myself. And, at the end of the day, just giving a better service to clients, that's been the most rewarding aspect of the journey so far.
Yeah, I think the biggest thing was learning how big the industry was outside of just the stocks that we were trading, right? Outside of the CSLs, the BHPs, mineral resources, for example, the ANZs, despite how great those companies are on their own and how much, I guess, clients can make off of trading those stocks within their portfolio, there's a greater and larger world out there within the alternative space that was new to us as advisors when we first started, and even newer to our clients. And being able to educate ourselves in such a short amount of time, believing in the solutions and the strategies that River X has established, and getting clients to explore those opportunities as well has been the biggest game changer, I guess, in our career.
Yeah, I think for those who don't know, I come from a stockbroking background. I spent over a decade at one of Australia's largest mid-tier firms, and majority of my tenure there was focused on stocks only, like buying and selling stocks.
Yeah.
One thing that happened at that business, and it's very common in the mid-tier and smaller end of the market, is they have a high focus on corporate transactions, and those transactions often are not best quality. I mean, let's face it, all the good quality deals sit at the top end of the market. They come through the investment banks first, and then if they get rejected at the investment banks, they then normally get picked up by a mid-tier or sort of more boutique manager at the end of the market. And occasionally you can find good quality deals in that space. But the ECM teams in that space kind of know the landscape pretty well. The difficulty I found, and I think you experienced as well, that both of you experienced, was that you'd often be presented with a transaction that would look good on paper. It might have the research wrapped around it, but when you dig it 2 centimeters deeper, you find that it's a corporate mandate. The biggest winner is the firm. Now, River doesn't have that. We don't have those corporate mandates here, so we're completely independent. Have you noticed with your clients, just not having those types of deals put in front of them, have you noticed that your clients are more receptive to the things that we offer them now, given that we're completely independent?
I think the biggest key point of difference to that note is the client surprise when we facilitate the application for them and have all the necessary, transactions, monetary transactions that take place, that River or we don't receive any of those funds. It goes directly to the investments or the funds themselves, which again, for our clients who have been in that existing model that we were at before, coming into that has been a massive change of pace for them and has built on the trust that they've had with us since then.
Yeah. And speaking of which, what sort of transactions do you think your clients really like? Because coming into this environment, we give you access to a lot. We have a focus on alternatives. We have access to traditional assets. So, I'll send around opportunities that we get from investment banks, things like capital notes, bank hybrids, bonds, even placements that we see on traditional equities. But then I'm also sending opportunities to go into things like regional shopping centres, private credit funds, private equity funds, venture capital deals. So you're getting shown a lot.
Yeah.
But out of the investment universe, where do you think you're seeing the most interest for your clients at the moment?
I think the diversity is really important. And to answer your question before, now it's a lot more about, in previous roles, you're taught to objection handle, that type of thing. If a client says no, what do you say to try to get them to say yes? Whereas now it's more about, okay, there's no pressure or anything like that. We're always going to have things rolling through the door. But there's, to answer your question, there's so many interesting points. In the last month, we've been given a shopping centre deal at a very good valuation. We've been given private equity deals that have, a lot of, I wouldn't say predictability, but, a very well-equipped fund manager who's been doing it for a long time. So just being able to present different options to clients, I think that's been really exciting. But in a nutshell, I think the Australian real estate, the commercial real estate that we're getting, that's a lot of clients are really gravitating towards that because, it's safe. They're institutional grade assets for the most part, and it's nothing that they've ever seen before.
Or have had access to.
That's the point of difference, really, because and you guys knew this when you came on board. When you work at a big firm, you're always viewed as a competitor. So if I'm working at a large mid tier, I found it difficult to get stock or opportunities off another mid tier. But the first thing I did was set up institutional accounts with every investment bank, with every firm that I wanted to deal with. There's lots of firms I don't want to deal with for obvious reasons. And then basically my job was to then build or provide infrastructure for advisors to come in, create a nice home for them, and then just offer them good deal flow. It seemed to me like it's not being done in the market or not being done too well if we look around the park. And the nice part for our clients is, now I come to you with a deal. There's no pressure for you to take any deal. We don't have a horse in the race. It's all about the best outcome for the clients and their best interests. And it's interesting to hear that they like the commercial real estate because commercial real estate is something that's tangible. Our clients like. I know they like it. I know my clients like it. But you're coming from an environment where they're used to very liquid assets. It's a very different level of liquidity. It's a very different fee profile. It's a very different structure. So, how are you going with that transition? Because the clients are going something which is a T2 settlement model to something where it could be a 2, 3, or a 5 year lockup. How are the conversations going with clients about liquidity of those assets?
I think at the end of the day, it just comes down to the quality of the deals and opportunities at hand, right? They're willing to trade off, the volatility in the equity markets for something that's real, that they're going to be in for quite a long time, that is of quality, I think.
And I think it's about educating them, and that's where our special sauce is as advisors. It's about understanding the client's wants, their objectives, over their, what they're essentially looking to do with their capital and allocating it appropriately. If they want liquidity, then you don't put too much exposure in things that are going to be locked up for too long, so.
Yeah, I think that's true. The education piece has been really important. I would say, I don't know, we don't intentionally do it. We don't set it as like a training session perhaps, but I would say we spend, 5 or 6 hours a week with you guys at a minimum, so giving you like it would be training in passing, if that makes sense. So we're bringing in fund managers, we're bringing in other professionals in the industry all the time. We just had Frank Yu from Ali Bridge come do a roadshow for 2 weeks. We just had, who was it, Regal in our office the other day talking about how they're positioning themselves in the market.
Baron Joey's as well.
Baron Joey was in the other day. We've had, who is it? Eleanor, there's heaps. The list goes on.
every week.
There's so, we can go forever on who comes in because we've got people coming in every single day.
Yeah.
And it's just about giving you guys the education, and then that way you can pass it on to your clients.
Correct.
But one thing that's really interesting about getting these fund managers in, it's not just about hearing about what they're pitching, it's about hearing about where they're going and then how they're seeing the market going forward. So like the market is in a pretty peculiar position at the moment, I think. I think the RBA is in a very interesting spot because they're now in this position where I think they're going to have to signal some rate rises. And that's tomorrow. I think we've got there's some
Tuesday.
Tomorrow, 2:30. So we're in this interesting spot where you've got economists out there who are predicting 6 rate cuts at the beginning of the year. It's now back to 3, now to 0, and I reckon we'll see a couple of rises.
Yeah.
How are you guys seeing the market at the moment?
Yeah, I think it's important to be really nimble in this environment because at the start of the year they were talking about cutting interest rates. Now they're talking about doing nothing or hiking them, and there's a lot going on this year. There's a lot of uncertainty. You've got on a geopolitical sense, a lot of elections happening on a global scale. So I think being nimble is really important. Having the ability to execute on a strategy is really important. And I think just having a game plan you need to have in this environment. If you're coming into money and you want to invest, I think getting into the stock market now is probably unwise. I mean, there could still be some upside, and we're obviously still in the stock market, but it's just a very dangerous game to play right now. So I think it's really important to, protect your capital in this environment, not be too greedy, I'd say, but also still, there are ways you can get great returns for myself and my clients. We've been using private credit as an avenue to do that. Private credit is effectively non-bank lending. We only deal with funds that do first mortgage asset-backed, first mortgage asset-backed. So we're backed by a real asset, effectively. And it's, for the most part, Australian property, which is solid.
In addition to which, majority of the private credit funds that we give our clients access to, have been battle tested, right? Either they've been around for the last 10 years or they've had no negative drawdowns in the last 5. Why we say the last 5 is because COVID, right? How did they perform during an economic downturn that impacted on the global scale? So everything what Dan said.
It's interesting, right? So like I used to go to my clients with what would be some pretty spicy opportunities, like as a junior broker, my prior role. And every time I'd go to them with, what would be considered a hot deal that might give them a 15, 20 or 30% return in a short time frame, clients would always allocate the smallest amount of capital to that. Like clients are more intelligent these days. They're not looking for a home run on their transactions. Like I found that my inflows probably doubled or tripled when I started marketing lower risk opportunities. So going in and saying, well, okay, well, look, it's not about the upside, it's about how I can protect the downside. And my job is, so one of the principals and someone on the investment committee is to make sure you guys have always got quality funds in front of you. But that private credit theme is really interesting because now we're coming to a point in a cycle where people thought we weren't going to see rate rises, but now they're probably going to come again. So that could cause some pressure on the loan books. So that focus on quality is really what I think is going to help you guys as advisors. But when rates peak out, there's going to be a next step in this journey, and that's where risk assets will start coming back into the equation. Okay. So do you have an element of your portfolio ready to pivot towards that area of the market, or do you have some targets in mind about where you think you might go?
Yeah, so of course, we're still, obviously, for us, it's about having a diversified portfolio for clients. And like I said, being nimble, having, not all your eggs in one basket, because we could be wrong and they could cut rates. Who knows, right? We're in that sort of state where everything's all over the shop, really. So you want to have, targeted areas for different theses in the market. So right now since I'd say the end of last year, start of this year, we've been allocating to some of the small cap funds as well, like Regal, small caps. The small caps, basically smaller companies on the stock market, haven't performed very well over the last 4 to 5 years. They've actually underperformed. So they're looking attractive on evaluation. From a valuation perspective. Yeah, so small caps, we still like international equities through certain fund managers as well. So to answer your question, it's just like I said earlier about having spread out across different asset classes, really.
And having so when we conduct these, I guess, strategy sessions with clients for strategic asset allocation, a portion of their portfolio we recommend to be in cash. Or within these private credit funds that do allow that agility and allow them to be a little bit nimble with, redemption periods. And when we see a change in the market, we're able to, provide a recommendation also and say, yep, we're seeing a turn in the market, might be worthwhile to deploy back into growth assets.
Yeah, that's really important actually. So for the benefit of those listening, most of the funds that we look at, there's a whole, the private credit market has basically gone through a rapid amount of expansion over the past few years. And the reason for that is term deposits became relatively unattractive. Even now, I think the best one I've seen is, Judo Bank 3-month term, 4.9% annualized. Macquarie's at 4.8. Everyone's kind of around that sort of, 4.8 to 5% mark. And you look at where inflation is and clients just look at that and they go, well, I'm just treading water in this environment. And how can I get a better return than that without taking on a huge amount of risk? And you want to take a step up in risk because that's how you get a higher return. But you need to understand the risks and the mandates of these private credit funds as well. So when I'm looking at private credit, we do have a screening process at River for those funds that come to us. Typically, we're looking at multi-billion-dollar funds, track record, as we said before. But we do look for those that don't have the 12-month lockup, 24-month lockup. The reason why we like that is we can be nimble, and a lot of them have a 30-day redemption period. So if you're in a term deposit and let's say that interest rates are cut, yes, you're going to get the rate that you secured at the beginning of your term. But if you break before the maturity of that TD, then you're giving up some penalty interest. So you have to give back some of that return. Whereas in this environment, you don't have to do that. You redeem on 30 days notice, we can go and buy into some bombed out equities. And that's what we're seeing now. We're seeing a huge valuation gap between the large and small caps in Australia. There's a handful of good quality managers in this country. There's a lot of bad managers, unfortunately. But in this market, Regal is one of those good managers that we deal with, but there is a range of other good quality managers that we have access to. And bringing in their portfolio managers to understand the path forward for them as well, understanding their portfolio positioning, that really helps you guys to be in a better position to not only market yourselves but also win clients as well. Just changing gear a little bit, I think culturally the business that you've entered now is quite different to where you've come from. Just culturally and I guess about how we develop our team and staff, what are some of the main differences that you're seeing in this role compared to your last roles?
I think this role is very different because we're not paid a salary. We work under the grid. So it's all on you to deliver for yourself. Like they say, you eat what you kill or eat what you hunt, whatever it is. No, but that's how I sort of approach it on a day-to-day basis. And learning from you and the team that we've got. I mean, the initiatives that you do, things like personal training with the guys and girls in the office, a big focus on health and fitness and eating healthy and just being in a good state is, you wouldn't get that as much at other firms that I've ever worked at before. And I think to be in this sort of role where, markets are all over the place, you're building a book of business, you've got all these deals that you need to understand the risk behind and you need to really put the work in. Having that focus on health and well-being is super important, I'd say.
Yeah. I think for me, it's coming from the firm we were at prior. It was very, very competitive, right? You guys are all dipping in the same pond or the same pool for the same, same results, so to speak. Whereas here at River, it's been a little bit more of a community, right? Because I was thinking about this the other day and I was going to bring it up with you. It's that every day we're surrounded by entrepreneurs, which is all the advisors in the office. We're all business people, business leaders, running our own books, running our own systems, our own structures. And where I'm finding, I guess, the biggest benefit by being around everyone at River and all the advisors here is that everyone is on the same mission. Some people may have resources that others don't, and as opposed to bear hugging it, it's more like, all right, cool, let me help you. Here's what worked for me. Here's how it may or may not work for you. So I guess for me, on top of what Dan said, and all the positivity and getting your body and health right, I think being around other business people, young business people like yourself, like the other advisors, being around you, really just improves my day to day. On another level.
Yeah, so for anyone who's not watching the video part of this, we train. Anyone who's worked with me before knows that's part of my ethos, my work ethic. That's what I do. I train every day without compromise, sometimes twice a day. But that discipline keeps me grounded. And I've sort of brought that culture into River. So everyone in the office gets access to Lance, our PT, Lancey, our PT across the road. Twice a week they can go visit Lance, get a PT session. But we do boxing sessions down the park. We go for runs. It's not, you don't have to do it, but we suggest that it's good for the work culture. And keeping that health and fitness routine in place does give you that routine and that discipline. At certain firms they have different sort of machinations of this. Like they might have a compulsory morning meeting at 8:30. I actually think that's not really required in our line of work. And the reason why is, the reason for that meeting in most firms is to pitch you their own product. They say it's to get to know the markets, but let's face it, everyone reads the AFR. You don't need to be there for that. They're there to pitch you their product. They're there to sell you their corporate mandates. We don't have our own corporate mandates. We're here just to give you access to good quality deal flow. So whilst everyone is in the office at 8:30 or 9 every morning, building their business and building their book, we're all on this journey together where you guys are running your own business within River. Everyone has their contractors here. And what that means is that, we've all got to pull together, but I've created the REM model for the clients to be aligned with you guys. So it's all about, you are rewarded when you do well for the clients. If you do poorly for the clients, you earn less. It's not a transactional business model where, I've seen it in so many broking houses around the country where they sit there and they just turn over client portfolios to generate more revenue. It's a joke. The only winner is the broker.
It's not sustainable.
And it doesn't matter, regardless of the client outcome, the broker always wins, right? So in this scenario, it's funds under management. It's, you're charging a management fee. The clients can leave whenever they want. There's no lock-in. There's no setup cost. That means that if you're not doing a good job and the assets aren't growing, well, see you later. I mean, the clients can just walk. So I wanted to create that model for investors so as that they're not held in a situation where they don't want to be there. They can go at any point. But it also means because you're not getting those sugar hits on the transactional revenue, you have to work a lot harder to win their trust, to win more of their assets. So that's why we've got to be on point. There's very few boozy nights. We celebrate end of financial year, or if we have a big win, we all celebrate and we have fun. But it's few and far between. You just finished. I think you just finished
75 hard.
75 hard.
Yep.
Which is
75 days, 2-a-days, no alcohol, clean eating. For me, it was 80-20. 7 days a week.
Yeah. And the next thing we got on.
We got a KB and I working towards a High Rocks. I'm not sure if anyone knows what that is.
The High Rocks is like this CrossFit event, and I foolishly signed up for the men's singles. I didn't even know what it was.
Talked him into it.
It's like a 1K run, 1,000-meter row, 1K run.
It's an endurance race. 8 kilometers total. In between each kilometer,
and strength.
There's a strength component.
Strength components, which I'm good at the strength component, but forget the running.
It's the runs.
The running's going to be a challenge. But no, we're working towards that as well. And what I've done for the guys here as well is we get together quarterly. We're about due for our next one actually. And at the beginning of the year, I sit down with the guys and actually say, okay, what are your personal goals? What are your personal goals in the business? What do you want to achieve as individuals? And what do you want to achieve from, professionally from the client book? And the reason why it's so important to do that is it's not about me, but it's about tying your personal goals with your professional goals so as that you guys are then always on that journey to building towards a better client book, which we all enjoy the success of together.
Yeah.
So if we can align your personal interests with your professional interests and the client's interests, well, then we're in this really nice, harmonious environment. And I think that's why we've been so lucky with the outcomes that we've been getting and the people who we've brought on, because they're all part of that.
Yeah.
They're all part
Everyone's
of
on the
the
same
same
wavelength.
Yeah.
And journey.
On a
right?
mission.
Yeah, we're on the same mission.
Yeah. Well, you kind of have to be, right? Because it's only like you can't live on bread and water, right?
Yeah.
So you have to do a good job.
That's right.
But yeah, I think it's been awesome. So you guys have been with us for 6 months now.
Yep.
It feels like it's been a lot longer.
Yeah.
It feels like it's been a couple of years.
You know what? The funny thing you mentioned earlier, when we started, computers weren't even completely up yet. We were still in building phase. But for me, it didn't feel like it was in building phase as much as you saw it, because for us, everything was moving so rapidly in the learning side of things, the education and deploying for clients. So for us, it was just kind of just all blurred together. And now we're here. There's 15 other people behind us. It's been an insane amount of growth in such a short amount of time.
Yeah, it's a bit of a monster. But I think we'll see it again in the next 12 months. The things that you don't see are the things that I see, and being like both an advisor and running the business at the same time, I see things differently. But one thing that you guys would have realized, right? It was a startup, but it's not a startup. It's like I had an existing book of clients, I had existing corporate relationships, I knew where to get all the deals, I knew who to talk to, who not to talk to, which is more important. So it meant that straight away, even though it was a new business with a fresh logo and all that sort of stuff on the front, we had established inroads into finding quality straight away.
Yeah.
One of the good things about my prior role is I knew what I didn't want. And knowing that that might sound funny, but I knew what I didn't want straight away. I knew the things that I liked. I knew the things I didn't like.
Yeah.
There were lots of good things I took out of that environment, but there were lots of things that I decided to keep well away from this environment.
Yeah.
And that just leads to higher client satisfaction, more positive outcomes. If I'm thinking about the sort of average returns we're seeing, it's a lot better, less volatility, no drawdowns, all of that sort of stuff. And there was trial and error before you guys started as well. So before we even onboarded clients, we did try doing the old business model again. We tried doing some transactional broking. We tried doing a few corporate deals. It was just the same stuff all over again.
Yeah.
Like poor quality outcomes. So since we basically eliminated that from the business model, we never have to deal with that again. And you guys never got exposed to it. So while you were saying it might not have felt like that, I'm making decisions like what kind of headset am I ordering next? Are we getting mouse pads? These sort of like little things, but then making every decision, what sort of coffee mugs are we getting downstairs?
How many Nespresso machines?
Yeah, how many Nespresso machines? Well, now we need 2 because they get tapped out. But yeah, all that sort of stuff is just like a different change of gear completely in the business model. And for you guys, hopefully it felt like it was established.
Oh, definitely.
Definitely.
I remember the first month we came in and we had different fund managers. It's just a brand new world to us, but it was all quality stuff.
Yeah.
Which is why
We were blown away.
Yeah.
Yeah.
That's why we were very happy to come and, make the transition.
And I think that's why everyone else has come too. It's like, whenever you talk to advisors, and you wouldn't see this part, but if you're talking to financial advisors in other roles, they're normally very entrenched. It's a huge decision to move.
Yeah.
Because the first thing that happens whenever an advisor leaves another firm, well, their book gets cannibalized. I've seen it happen like multiple times. The minute you walk out the door, there's going to be 10 guys calling your clients, right?
Yeah.
So you need to make sure that wherever you're going to next, it's the right decision for you. One thing I would say about our business and the reason why we've got so many guys now is we've brought them in and we don't sell them the dream. I told each of you this is going to be a hell of a lot of hard work. I didn't make any promises. This is not a get rich quick scheme. But this is a model where you can build wealth for your clients and your family over the long term. For sure. But I think and you can tell me if I'm wrong, but I think the real turning point is when we actually show you. Like we actually show you the asset allocation, how we get the clients, the results they get. I think that's a big light bulb moment for guys when they come and sit down with us. Yeah. I think the other thing that's good is say you're in a business and they start doing bad deals. and I've been in one that did multiple bad deals. They also did multiple good deals.
Yeah.
But the problem was, for every 10 good deals, if they did one bad deal, it would just destroy all of the credibility or everything that I'd built up with those clients over that time.
Yeah.
And even though they were probably the right call for the company or whatever at the time, it was never the right call for me. It was never the right call for my clients.
Yeah.
And even if you didn't put $1 of your client money into those deals, you were just guilty by association.
Yeah.
And you get dragged down with it. And like, you would know this, right? So you guys had, I think there's 2 or 3 deals that stick out to mind. We don't have to name them on this. But those deals, when you go to a client and you present them your next opportunity, it wouldn't matter how good that next opportunity was, right?
Yeah.
Like they would just say, no, thank you.
They view it from a different lens.
Yeah, because the trust, the credibility is just gone.
Once bitten, twice shy, as I say.
Yeah, that's right.
Yeah.
So I think the benefit of being with us is like, being a personal investor myself, I'm in the same boat. I'm on the journey with the clients. I'm often investing alongside of them as well. And because I've been burnt on low quality deals, I just don't want them here. So hopefully that creates a more sticky client base for you then, and more
100%.
and a more collaborative environment between the advisor and I guess staff, because I reckon in this industry, it's becoming harder and harder to find an alignment between not just the client and the advisor, but the advisor and management.
Yeah.
Because often the objectives of the firm don't align with the objectives of the advisor and their client.
Yeah.
And that's where I think you can see, heads butting. Because like, if you think about it, like, the fee structures on these corporate deals, the way they work is it's like, we'll get a 6 or sometimes I've seen even 8% fees offered on these deals, which is just crazy. Like 6 to 8% for raising money for an unprofitable minnow on the ASX is just. But then they also have like options tied into it, and who knows whatever else benefits are tied into this sort of stuff as well.
Yeah.
The reality of it is, the advisors normally get a percentage of that. Normally not the whole whack, maybe 3 or 4% on grid. So the firm takes the biggest win. The advisors get a bit on grid, but then you're left holding the baby in that situation. One thing that I've been really proud of is that you've been able to offer clients exposed to these type of transactions a much better alternative.
Yeah.
Something where they're not obliged to come with us, but there's something there where they can recover their funds at the same time. Have you had any turnaround stories like that where you've had some clients that may not have had better outcomes in their former environments coming over and getting some good outcomes here?
Yeah, for sure. I mean, I think with any client you meet, especially for the first time, they always say it's about building trust. Everyone's been burnt before, especially in this industry, right? Not everyone, but a lot of people you meet, it's hard to trust a financial advisor because they don't know if you're doing it for them or for you.
For yourself,
right? I think our whole approach, when I don't even say I'm not selling anything to clients. I say I'm selling myself, my relationship with you, that I'll do a good job for you.
Yeah.
And when they see the sort of deal flow that we get, like the bank hybrids, for example, the private credit funds, there's absolutely no pressure at all. It's like, okay, if this one's not suitable for you, let me figure out what you actually need and let me try to find a solution instead of, no, this is why this is good for you. Like it's just a completely different game, really. But I think just that whole approach resonates with clients, and that's how we've been able to get new clients on board and really build trust with them, and that's led to referrals. Them getting their family members involved with what we do as well, which has been the most rewarding thing, really. Yeah.
I think for me, I guess the turnaround story or point would be initially thinking that the amount of deals that we get and circulate with clients would overwhelm them. But I think the key turnaround is offering them options and diversity, which, for me in the beginning, I thought, what if they decide they like this second one that I presented and rescind in their interest in the first one. But it's become more so, all right, Ken, Dan, you guys have just been generating a bunch of good deals. What else do you have? Right. And through that, we're able to diversify their portfolio just from the deal flow that we have access to, that we've been getting.
Yeah, I would say that's true. So if you're setting them quality, you can't send them enough of it. And the truth of it is, for people bidding into these deals, there's actually scarcity of these products in the market. I would say that there's a glut of low quality deals. Like there's so many that we get sent. Like you guys don't see it.
Yeah.
I get sent like 10 a day, and I have to say no to 99% of these deals, and we might pick one a week that we're going with.
Yeah.
And we look at deals, and a good example of this is the capital notes that we get. I get them because I've got relationships all over the market. But one of the more recent offers, it was a $300 million bank hybrid. The yield was about 7.5%, which doesn't sound too exciting, but much better than a term deposit. That got about $1.5 billion of bidding into it. We got scaled back massively on that one, which sucked. But it's seen a nice uplift on market. I had a look this morning. It's up about 4.5%, which is awesome for a bank hybrid. You don't normally see that. That tells you the quality of the hybrid that we got. And the other one that we went into, which was a regional bank one, that's also up about 3%. So we're seeing capital growth on income securities and also getting those nice yields coming through, plus franking credits for the clients as well.
Yep.
And that's one thing, like when you're sending out this stuff, you can never go wrong with quality. It's if you just give them quality, it might sound boring, it might sound vanilla, but I had a client in the office at 8:30 this morning before this meeting.
Yeah.
And his words to me were, "You're so boring, but I like it." because I'm not trying to get him 20 or 30%. I think he's after fees it's about 11.5% per annum he's getting. But that's awesome. If I can do that for him every single year, net of fees, without introducing leverage or high levels of volatility, that's the job done for me in my eyes. Is that aligning with your client expectations? Because they're coming from this environment where it was you're in the stock market and just looking at the returns of the market, right? The NASDAQ in the past 5 years, the average return's about 22% per annum. You look at the Australian ASX 200, it's about 8% per annum. Pretty average. But clients have this perception that equities should outperform property and should shoot the lights out. So how's that going how are clients' expectations going coming from this high growth environment to this lower volatility environment?
Yeah, I think it's very different and they're getting used to it. But just because the stock market does well doesn't mean every client invested there does well. It's, you get all these stocks that are, there's different cycles, right? And a lot of clients, they all have stories of they've bought a stock when it was too high and they haven't experienced the growth of the market. A lot of retail traders will actually underperform the ASX. So I think coming into an environment where we have more, I guess, predictability, more foresight on what returns we can achieve and really just under promising and over delivering. That's been the biggest difference. And clients are a lot, when I speak to clients, they're a lot happier because we're not talking about what happened in the US last night or Jerome Powell said something and the market's crashed. There's none of that. It's about, you're getting this fund delivered at 80 bips this month, for example. It's in line with what we expected. So
it breeds trust. I think bottom line, it breeds a lot of trust. And that just doesn't, mean that we're going to completely pull away from the equity markets. But more so during times like these where interest rates are at their all-time highs and they're getting a consistent return with lower correlation to the share market, month in, month out or every quarter, it definitely breeds trust with those that have been burnt before in the past.
Yeah. I think that the unfortunate thing for our competitors is there's a lot of low-hanging fruit, right? If I look around the market, there's a lot of those stock-focused firms that are just, they've just dropped the ball. And I think it's may not talk to the quality of their business, but it's just the business model in the sense that, you look at it and you're going to see volatility there. You're going to see downturns, 100%. Yeah. Every couple of years, we're going to see a washout. It's going to happen. So, as an advisor building a book, you want to have a robust risk management framework wrapped around your clients. And speaking of that, I mean, that's how you create security around your business and your earnings as individuals as well. So, we're trying to do things to deliver more value to our clients outside of the investment returns. Because just tying into what you're saying about trust, we want our clients to know us. We want them to see us. They want us to be engaged with us. So we've hosted a couple of client events this year. We did our first client event at our office, which you guys brought some clients along to.
I
think, which was good.
Brought a couple of clients, some
Yeah.
Referral partners came along. It was a good time.
Yep. And then you did the Hellenic Museum as well.
Yeah, for the Alley Bridge Roadshow with
Yeah.
Frank Yu.
Yeah. And then what else we got? Oh, so we've got a couple of other fund managers due to come in, which will open up to clients as well. So
Yes.
I think just keeping that front-facing focus with the clients is good. And we expect, we hopefully, if we can sign this lease, I want to get to a bigger space.
Oh, yeah.
You guys know it's been the bane of my existence. I want to get out of it because
Yeah.
unfortunately we're running out of desk space. So I'm going to have to either put some desks in the hallway or something. I don't know. But we've got more advisors looking to join us, and it's because of that sort of competitive grid model, but also the better product offering and clean reputation, all that sort of stuff. So that's really important for the advisors and the clients, but also just making sure that we continue to get the best investment returns as well. So we can continue to support the growth of River, because now we're sort of at this interesting point where you guys have been with us for a while. You're getting some great traction with your different marketing initiatives and campaigns, but we want to make sure we can continue to foster that growth.
Yeah.
So you can keep building your book.
100%.
I think I've got a personal target for you guys, and you don't have to say the numbers on here, but we've all got personal targets in terms of funds under management and where you want to get your businesses to in the short, medium, or long term. And hopefully we're doing the right thing and giving you enough initiatives to do that.
Yeah.
So I think we're in a pretty good spot for the next 12 months and beyond.
Yeah.
All right, guys. Well, thank you so much for taking time out of your day to join with me on Upstream with River. To everyone listening, thank you so much for your time, and look forward to reconnecting with you soon.
Thanks for having us.
Thanks for
Ken.
having us.
Appreciate it.
Cheers, boys.
Cheers.